Financial fitness checkup from Cornerstone Investment. We're talking about building that household balance sheet, budget, the building blocks you're going to need to get your personal finances straight.
Absolutely. The critical piece to putting together a financial plan are a balance sheet, which includes the assets, the things that you own, and the debt that you owe on those things that you own, as well as a household budget. If you know those two things, you can start taking steps forward and get things moved from the budget into the balance sheet.
Now, this is what you want, because you don't want, first of all, you're going to have to strike a balance at some point, because you don't want to be overextended.
Exactly. The main thing to focus on to start with is the budget, because you want to take a look at the income that's coming in and compare that to the expenses and figure out ways that you can reduce those expenses. Figure out things that are reasonable to reduce. Say, for example, if you have a cell phone plan that has more minutes than you use, and you can reduce that plan and save $20 a month. Things like that. Switching from one cable package with all the spiffs to another one that is more reasonable. Small ways to reduce your expenses gives you more flexibility, because what you want to do is you want to move from having what are known as fixed expenses, those that you have to pay every month, to a little bit more discretionary income. Because when you do that, you can actually save a little bit more, and you can be prepared for things when they come.
Essentially another name for cash flow. You want to have some cash flow, and you want to have that flexibility where I've got to pay the light bill, I know I'm going to. But it's not going to kill the budget. Right.
You've got to pay the light bill, but you don't have to eat out 3 nights a week.
Right.
And a perfect example of how this can help is we just got our insurance statement for our homeowners policy recently, and our insurance went up, roughly 35–50%, something like that. If we don't take a look at that and figure out how to move expenses around with the budget, then that's less money that can go to our balance sheet, because balance sheet's where you really build net worth and build kind of a cushion and a pad and a safety net for yourself.
And of course, balance is the key word in that, because if you can lower the expenses and raise the money coming in, and you're putting down on the balance sheet, then you're in you're in good shape.
And that's a very good point, because when we talk about this, we don't talk about counting every penny, because if you do that, you're going to be a little bit neurotic about things, and it's not going to be an easy process. You're likely to give up on it. Just know generally what you spend on different things each month.
Yeah, and we talk about, if you will, when you talk about budget, a lot of people do kind of look at that and go, well, this is concrete. These are all fixed things in the budget because it's in the budget. But the budget needs to be somewhat fluid, doesn't it?
Absolutely. Absolutely. If you don't have some flexibility there, you're not going to be able to absorb those items that come in and force you to spend money that you otherwise wouldn't necessarily need to spend.
And we're not talking about, you don't want to be juggling. You want to just make sure that you're prepared when you know you have certain expenses, you're going to be able to address those.
Right. And we've talked about, fixed versus discretionary, but also some things to do to help you make better decisions, to move more from the income statement into the balance sheet. Consider the terms of your debt. A lot of people want to get rid of all the debt that they've got, and sometimes that's prudent and sometimes it's not. It really depends on how much this money that you're borrowing costs. And you compare that to what you could earn on it in other places. A lot of people want to pay off their mortgage as quickly as possible. If you're opposed to debt, that's a great thing to do. But if you're comfortable with a little bit of a mortgage and you're, say, borrowing at 6%, and that's a tax-advantaged rate because the government is providing a rebate on your taxes for the interest that you pay.
A lot of people do have the lower interest rates right now for homes.
Absolutely. And if you have that lower interest rate, it may be a good idea to go ahead and have a mortgage, but make sure that you pay off the credit cards that are at 16–17%.
High interest credit cards, you got to get rid of those.
Absolutely.
Carry that balance, a lower balance, if you're comfortable with it, though. Mark Davidson, our guest. Good tips. We're coming back. Just a moment. Stay with us.